Now, the focus for banks this earnings season is what are deposit levels like? With many major banks offering low interest rate levels on deposits, despite higher yielding bonds, US 10-year bond yields are offering a 3.40% yield at the moment. Are depositors moving their accounts in search of better returns? That's one of the worries that the market has. And the danger for US banks is they could face a liquidity crunch if too many investors seek to withdraw too much cash at the same time. So there are risks this earnings seasons that banks see further selling as investors digest their earnings and the customer deposit levels. Now on Tuesday, April 18th, the Bank of America and the Bank of New York Mellon announced their earnings, along with Morgan Stanley announcing their earnings on Wednesday, April 19th. Now if you just take a look at the earnings over the last, at the seasonal pattern over the last 25 years rather, what you'll notice is that the stock tends to move sideways during the summer months, and it's sort of a 50-50 whether it's a winning or a losing trade, but the average return is minus 3.25%, so it does tend towards falling. And if we just look at this and compare the Bank of America here with the Bank of New York Mellon, let's just call that up. We can do a nice little comparison here. And what you can see is it's a very similar pattern. This negative falling pattern that's mirrored by the Bank of New York. And if we compare it with Morgan Stanley, we see again a very similar pattern. So these banks have a weak seasonal pattern, and they're all entering a slower time of year as shown by the seasonals. So could we see some downside if there are worrying signs about deposit levels over their earnings? It's definitely something to look out for, major trade risk. The major trade risk here is that the earnings continue to surprise to the upside and deposit levels stay stable. Remember, don't just trade it, but season exit.